Hello, my name is Sine Sibia. Thank you for listening to this podcast. I'll be taking you through a performance update of the Alexforbes high growth portfolio to the end of the first quarter of 2022. The objective of the portfolio is to generate returns geared towards long term growth with a target of CPI plus 5. The long term nature of this portfolio means that over the short term, returns are likely to be volatile. Ideally, an investor should have a minimum of 5 years to retirement. Looking at the structure of the portfolio, we see that, as the name does imply, it is a growth oriented portfolio and it has an allocation to quite a high allocation to growth oriented asset classes. When we look at the pure equity local building block, which is about 46.8%. But nonetheless, the portfolio is well diversified across the different asset classes as well as the different underlying managers. We also see that it has an allocation to global assets at 26.4%, to alternatives, which are the unlisted securities, at about 10%, and then the tactical building block, which allows the portfolio management team to make more tactical calls in light of the long term strategic weights of the portfolio at 7.6%. Then there's an allocation to bonds at 4.8%, and then property at 3% and Africa at 1.4%. The AFI Growth portfolio marginally underperformed the benchmark over the quarter and was in line over the 1 year period. The main drivers of performance in these time periods are predominantly the pure equity local building block and the local alternatives allocation. The longer term periods is where the portfolio has struggled the most, with select building blocks underperforming their respective benchmarks for a variety of reasons. A decision was taken in the first quarter of 2022 to add more to local equity over global allocation, which contributed positively as the South African market stood firm compared to the rest of the world that was in negative territory. The view was that South Africa would suffer the least in this environment due to its resource centric nature. Our position was opportune, so we would be able to latch onto the rising commodity prices and benefit from them as we have, with many market commentators classifying South Africa as a safe haven for global investors. Over the quarter, the pure equity local fund has underperformed its respective benchmark. This is attributed to mainly two factors: the Russia Ukraine conflict and the continued Chinese regulatory pressure on the tech sector, resulting in underperformance from the likes of Tencent. The equity managers who suffered under these factors were Excelsior and Benguela, which also were underweight gold, which hurt performance. In terms of how the Russia Ukraine conflict affected these managers, is around how the conflict increased commodity prices. And these two managers were underweight the resources sector. The China effect came through the overweight allocation as both managers had exposure to Naspers and Process, which got hit by the Chinese regulators through Tencent. Looking at the other managers, MNG, despite underperforming the benchmark, managed to deliver positive absolute returns, with key contributors coming from their investment in Sasol, Standard Bank, and Absa. 361, who were the best performing asset manager in pure equity local, also managed to register strong positive absolute returns, with key contributors coming from their holdings in Sasol, Glencore, and Standard Bank. The exposure to domestic hedge funds contributed to absolute returns and outperformed the AF High Growth benchmark in a strong SA equity environment over the past 12 months. In particular, the equity hedge component performed better than the fixed income hedged strategies led by long short bias managers benefiting in an up market. Globally, the rest of the world wasn't insulated from the Russia Ukraine conflict, along with the inflation rising, the Fed being more hawkish, and China's zero COVID policy. In terms of Africa, even though the market was significantly down due to the biggest weighting in the benchmark, Egypt, suffering the worst due to the Russia-Ukraine conflict, the fund held up well. The pure fixed interest local managers also did very well, with their positioning on the longer end of the curve driving their good performance over all time periods. And once again, looking at the portfolio at a high level, looking at the long-term strategic weights, we see that the portfolio, once again, as expected, has quite a high allocation to growth assets, with the combination of local, Africa, as well as global assets, equity being an exposure at 67.4%, property at 6.8%, bonds at 14.2%, cash at 3.5%, and alternatives at 8.1%. Thank you once again for listening to this vodcast.